know about. Liquidity can be classified as active, passive, retail, institutional, hidden, fake, and latent. Let's first differentiate between active and passive liquidity. Passive liquidity is represented by the limit orders you see in the order book or depth of market. It's passive because it doesn't initiate price movement. It waits to be consumed by market orders. Market orders, which do initiate price movements, are considered to be active liquidity. They attack the passive liquidity from limit orders, so to speak. Liquidity can come from the retail side or from the institutional side. For example, the limit orders you see in the order book or DOM are an aggregation of limit orders coming from retail traders and from institutional traders. The same happens with active liquidity. There are market orders that come from retail traders and market orders that come from institutional traders. So both retail and institutional liquidity can be active and passive. The DOM most traders are used to is level 2 DOM, where limit orders are aggregated. In level 3 DOM, there can be differentiation between sources of liquidity. With access to level 3 data, you're not just seeing how much liquidity is at each price, you're seeing who is placing it. Hidden liquidity is a type of institutional liquidity which can be active or passive. Passive hidden liquidity is the one coming from what are called iceberg orders, which are limit orders that only appear partially in the order book or DOM, so they don't draw the attention of other market participants. Active hidden liquidity is when an institution executes a large trade through a dark pool. This order will not be reflected in the public order flow, but it will affect price action. Another type of passive institutional liquidity is fake liquidity, which is characterized by something called spoofing. Spoofing occurs when an institution places a large limit order without the intention of actually executing it. The goal is to change the perception of other market participants watching the depth of market. This is usually a battle between institutional players. Retail traders just get caught in the middle of it. An important type of liquidity for you to learn how to trade is what is called latent liquidity. Latent liquidity is a type of active retail liquidity, and it is characterized by stop orders. Stop orders are held by the broker until the market reaches that level. Then it's immediately transformed into a market order, and it will emerge in the public order flow. Previously, I said that liquidity is the fuel for the smart money. Now we can state more precisely that the type of liquidity that fuels the battle between smart money and retail traders is latent liquidity. The reason we are studying these different types of liquidity is for you to realize that there are other battles going on in the market beyond the smart money versus retail traders. The market is not just a binary battlefield between smart money and retail traders. It's a multi-layered arena where institutions, algorithms, market makers, retail traders, commercial traders, and even governments play competing games, each with their own goals, strategies, and timeframes. The tricky thing about this is that all of these battles take place in the same arena. In other words, timeframes and market players coexist, interact, and intersect. However, that's a more complex subject for another time. So where does liquidity come from exactly? Liquidity can come from any market participant. When you place a trade, you might be interacting with another retail trader, a whale, a market maker, a hedge fund, and even a large bank. However, the market makers are the participant who have a liquidity provision role. In technical analysis, a market maker is analogous to an entity that can manipulate price in the same way a large speculator would, which is only partly true. Market makers can nudge and absorb price movements, but in a different way compared to a large speculator. A large speculator willing to manipulate price requires liquidity to operate, but market makers create liquidity. The issue is that market makers can also tilt the order flow to one of the sides in specific situations, so not only they can provide liquidity, but they can remove it or skew it. To grasp that, it's useful to understand the geometry of liquidity. One very useful way of understanding what market makers actually do is to visualize their role using simple supply and demand curves. In this graph, We have price in the vertical axis and quantity in the horizontal axis. The demand curve represents the behavior of buyers, and buyers always want to buy low. That means that the demand curve is downsloping. The lower the price, the larger the quantity that buyers want to trade. The supply curve represents the behavior of sellers, and sellers always want to sell high. That means that the supply curve is upsloping. The higher the price, the larger the quantity that sellers want to trade. Notice that there is a conflict of interest between buyers and sellers. The point where the supply and demand curves intersect is the current price. It represents a compromise between buyers and sellers. However, that's just the theory. In the real world, buyers and sellers try to anticipate each other's behavior through publicly available information. The consequence of that is that there is always a gap between the highest price buyers are willing to buy and the lowest price sellers are willing to sell. In other words, in reality, it's as if the point of equilibrium was tilted to the right, generating two distinct prices at all times. The bid price, which is the highest price that buyers are willing to trade at, and the ask price, which is the lowest price sellers are willing to trade at. This gap is often too large, and that destabilizes the market because it represents low liquidity, and low liquidity can exacerbate volatility. This is precisely where market makers enter the stage. They are liquidity providers. They will quote bid prices slightly higher than the current bid and ask prices slightly lower than the current ask. The higher bid will attract some sellers, and the lower ask will attract some buyers, therefore reducing the bid-ask spread. The market maker's profit comes from the difference in the narrower spread. In other words, market makers are liquidity providers, but they also have a dark side. This liquidity provision role allows them to remove liquidity in certain cases, creating a liquidity vacuum. We're going to explore the dark side of market makers in another video. Once again, this information is for you to realize that there are multiple battles happening in the market beyond institutional traders versus retail traders. Market makers compete with one another, for example, and that has direct effects on price action. With that said, let's turn our attention to the liquidity concepts you can indeed use in your trading. This leads us to the importance of latent liquidity. Institutions cannot see latent liquidity because it only emerges when brokers transform stop orders into market orders. But the crucial point is that the most obvious of these places is right above highs and right below lows. Retail traders assume that when the market breaks a high, it will continue to the upside, and when the market breaks a low, it will continue to the downside.